Happy Friday. We have a brand new Chart This with Gary Wagner up next. Gary, thanks for being with us this Friday.
My pleasure. My pleasure as always, and it's great to be back here with the Chart This viewers.
Gary, gold is hovering around the $1,300 mark as we speak. On Thursday, we saw it reach a 4-week low. What do you make of the price levels we're seeing in the gold market?
The $1,300 level was absolutely a key level in the market. And once it broke that level, it absolutely confirmed that we were in a corrective pattern. In terms of an Elliott wave, I'm looking at some sort of A, B, and C. The last B wave that we saw, which is our counter wave, took us to a high of about 1318. When it couldn't hold 1305 and 1300, it confirmed that we're probably in some sort of a C wave. In terms of my numbers, 1293 is a 50% retracement, and 1280 is a 61% retracement. So if we cannot hold a 1293 area, which we did breach yesterday, I would look for the market to go as low as about 1280 before bottoming out.
Now, Gary, in the past when we've seen black swan events or extreme geopolitical tensions, we've seen gold act as a safe haven, but not so much right now, Gary. Why do you think that is? Or why do you think it's not able to hold its rallies?
There's no doubt. Whether it is that investors have become numb or jaded to the geopolitical uncertainty that's evident in the market, what we are seeing is the market slow to react in terms of pressing safe haven premium into the market upon any kind of geopolitical action that really creates more uncertainty globally, and very, very quickly to watch that erode. In fact, we've seen the market really take back and then some any of the safe haven premium that has come in over the tensions in the Gaza and Israel, as well as the downing of the Malaysian airliners just recently.
Gary, we had another Elliott wave trader on earlier this week, and he was expecting or expects more downside pressure for gold in a shorter term. Do you see the same?
Well, in terms of the Elliott wave count, as I stated, my sense is we are currently in an A, B, C corrective pattern. We're in the final C wave, which could take us as low as about 1280. So in that way, I do agree with the other technician that you spoke with in that we could see continued downside pressure.
All right, Gary, on that note, let's get to your weekly insert. Last time you were on, you gave us an in-depth analysis of the current levels we were seeing in the gold and silver markets. What have you brought us this week?
You know, it's been a while. And so the insert today is going to be a forecast and get our viewers up to date in what we're looking at in terms of the technical indicators that seem to be prevalent within gold and silver pricing.
All right, we'll get to your insert now, Gary.
On today's insert, I want to take a look at our current model, both through Elliott wave and through candlestick patterns, and kind of bring all of the Chart This viewers up to date as to what we have been looking at and what we believe will be the probable outcome or forecast for gold prices over the next couple of weeks. Now, on our last episode of Chart This, which was roughly around the 4th of July, we were just coming into the tail end of a major rally, and this rally took the market from roughly 1235 on the low to a high of about 1342. So roughly a $100 move. Since then, we have seen this market absolutely come under pressure as it hit a top here. This is a weekly chart at 1242. The predominant overlying factor, the characteristic of this market over the last 2 weeks have been dramatically lower pricing. Now, there's a couple of indications that we received that really gave us the indication that we would have lower pricing. And really, to look at it, I want to take a look at a couple of candlestick patterns that really gave us a pretty clear roadmap, and then take a look at our current Elliott wave count so we can give you an idea, when we combine that with Fibonacci retracement, of where we think this market is going, both short term as well as interim term. So to put this all into perspective, we're going to take a look at our longer term Elliott wave count as well as our sub count, the current count that I'm looking at. Now, on the longer of the wave count, we absolutely at the beginning of this year hit a double bottom that started the wave count itself at 1, this double bottom at 1182. We had our first wave up, which was what, a $200 rally, and from there we had a very, very strong correction, because typically the corrections we would expect to see would be approximately 61%, and that would be the maximum of what we would be looking at. However, in this case, it fell far below there and actually went to just above a 76% retracement below there, and any kind of a wave count would have had to have been invalidated. So we had a large 1, we had our 2, and then we hit this bottom here, which is at 1241, and I believe that that's where we started what is an impulse wave number 3. Now, as you know from past shows, that impulse wave number 3 is going to be subdivided, and it's going to be subdivided into a series of waves, and I believe that it will probably be a 5 count, and this is what the sub count that we're looking at currently looks like. I believe that we saw in this most recent rally beginning at June our wave 1. That wave 1 would have been a 5 count going up to the market. We hit this resistance at roughly 1345, and then we went into our sub count, in which we were in a wave 2, and that's currently what I believe we're in, a corrective wave 2. Now, that corrective wave 2 can be subdivided just as you get a 1, 2, 3, 4, 5 on the way up. Typically, you'll get something like an A, B, C on the way down. Under that particular model, I believe what we witnessed, first of all, at the beginning of July, in which we got to the top, this would have been our A right here. And then typically on a B wave will go anywhere between 50 and 75% that of your A wave. So we get the market coming back up, and it goes a little bit above this 50%. And 1318, of course, to me was an important number for that reason, and then began to move back down. So what I'm looking at is the following count, of course, and that would be that we have completed our A wave down, we have completed our counter wave, or B, we are currently in our C wave. Now, on a C wave, there's a couple of ways that can actually unfold. If it has an equal low to A, meaning the low that we saw in A and the low that we see in C are equal, it's simply called a flat. On a typical retracement, though, your C wave, your final concluding C wave, would go below the A wave, and typically as low as 61%. So, as I said in the interview portion of Chart This, I believe that the bottom of this market, where we will see this market find some absolute support, if it does not find support here, meaning a flat, because realize that the flat really turned out to be a 50% retracement of this most recent rally. In other words, we had the market rally roughly $100, come back down to a 50% retracement, move back up to above 50% of this correction, and now is beginning to move down. If in fact the market cannot close and find any kind of support above 1293, I would look for the market to move below that and find support roughly at 1280. So with that model in mind, what, if anything, are we able to glean from the candlesticks and candlestick patterns that we see in the market? When we take a look at this first top here, although it'd be very, very difficult to act on this being a daily chart, We certainly had what's simply called an engulfing bearish. It's a 2-day pattern. We completely engulfed, went much, much lower. Following day, we had continuation or follow through. When we got to this bottom here, we did get a pattern simply called a piercing line. That gave us an indication that this market was probably going to move higher. We got our confirming candle the following day, but then on the day just following that, we hit what's called a tweezer tops. Tweezer tops are simply a 2-day pattern in which you have equal highs in the market. First thing. The second pattern that was identified is simply called a dark cloud cover. Now, a dark cloud cover is the opposite of a piercing line, and what you get in a dark cloud cover is after the market has been moving up, you get an open that is at or above the prior day's close. Green candles mean that it opens and then closes higher. Red candles opens and closes lower. And then what happens with this red candle is that it closes at or below the midpoint of the prior candle. And we were close to the midpoint of this prior candle here. Since that point, we have had over this last week consistently lower pricing, even with all of the geopolitical chaos and uncertainty that's going on, in which we have consistently seen this market go to a lower low on a closing basis than the previous candle. This is being recorded Thursday evening in Hawaii, which means it's now trading overseas, and this is the Friday's candle, which is just beginning to form now. As I said, we would look for some sort of potential support. If it's at 1293, we will be able to identify it with some sort of candlestick pattern, such as a piercing line, engulfing bullish, or a couple of other different patterns that are identifiable as key reversals or pivot points in candlesticks. If it cannot hold this particular area, as I said, we would look to see a continuation until the market finds support, and I believe that the most logical place to look for that, should we see more defined pressure in the market, is going to be roughly 1280. For the most up-to-the-minute analysis that we offer, you can always go to our website, thegoldforecast.com. If you're not a member of Chart This after the show, just go ahead and sign up. The links are right there on the front page, and there we will always make available some bonus content that will fill you in from the difference between when I recorded this insert and any pertinent market activity that's happening on Friday. Again, candlesticks, Elliott Wave, and Fibonacci as they pertain to our current market forecast.
Thank you so much, as always, Gary, for putting that together for us.
Thank you. Thank you. My pleasure as always. And I want to wish all of our Chart This viewers a great weekend and prosperous trading next week. We'll see you real soon. Bye-bye.
Happy weekend to all, and today we launched a brand new newsletter on Kitco News. It's a weekly roundup. It will be a recap of all our top stories and videos. You can register. It's free at the link below. In the meantime, I invite you to email us any feedback at newsfeedback@kitco.com, and we'll see you next week.